Hello friends, good evening and welcome to Super Coaching Regulatory Bodies by Testbook and also welcome to this practice batch. So this is going to be the part 10th guys जो हमने यहाँ पर डिस्कशन चालू किया है. So this is going to be the part 10th. इससे पहले we have already covered 9 sessions with respect to the important concepts of the ESI. So as a part of this important concept of ESI, what we do basically, we here cover 20 important MCQs based on the important concepts of the ESI component, and this component is important for both RBI Grade B 2024 as well as NABARD Grade A 2024 examination. दोनों ही examination के लिए this component will be very important, and you know very well phase 2 of RBI Grade B is to be conducted on 19th October and phase 2 of NABARD Grade A is to be conducted on 20th October. So the questions, the concept that we are discussing as a part of this session, basically this will definitely help you for these upcoming examination. तो चलिए start करते हैं. So this is going to be the part 10th and this is going to be the last session before the examination. Now friends, before starting, one important thing here, that you know very well that we have started the current affairs series, right? Those who are not aware guys, we have started this current affairs series because you know the demand, the requirement in the regulatory bodies examination has been changing over the period of time, and now they are more focusing on the current affairs part, and that is why we have started this current affairs series where we are covering all the possible dimensions which are asked in the examination, like for example PIB current affairs, finance current affairs, RBI updates, government schemes, ESI current affairs, important reports. So all these areas are covered. So sessions are conducted from Monday to Saturday at 6 p.m. Time is fixed, right? So if you see the schedule here, if I tell you about the schedule, so session related to PIB current affairs is conducted on every Monday at 6 p.m. by Pushpak Sir. Session related to finance current affair is conducted on every Tuesday at 6 p.m. by Madhav Sir. RBI update session is conducted on every Wednesday at 6 p.m. by Madhav Sir. Government scheme session is conducted on every Thursday at 6 p.m. by me. So just before this session, we had the session on government schemes. Then ESI current affairs session is conducted on every Friday at 6 p.m. So tomorrow we will have the ESI current affairs session at 6 p.m. and that will also be taken by me. And the important report session is conducted on every Saturday at 6 p.m. by Mahesh Sir. So this is the schedule that we follow basically. So if you want to prepare the current affairs very well for the examination guys, you can follow these sessions. They will be very fruitful for you for the preparation of the examination, because in these sessions we are not only telling you the important current affairs, rather we would also tell you how to identify the important dimensions, what current affairs are important, what current affairs are less important, so that after the time of 1 to 2 months when you keep watching these sessions, so you will be able to identify the current affairs on your own. ठीक है, फिर आपको किसी की हेल्प की जरूरत नहीं पड़ेगी. You would be able to understand the things whether this is important for the exam or not, right? So this is our intention behind this current affairs series. Now let's begin the today's session. First of all, achievers question, you know the ritual here. First of all, we discuss the achievers question of previous session. So the previous session mein, what was the achiever question? That what does a budget deficit indicate, right? This was the question that I have given you in the previous session, that is yesterday's session. Options are government revenue is higher than government expenses, government expenses exceed government revenue and expenses are equal, government expenses are covered by foreign aid, or government revenue is used for repaying previous debts. So this was the question that I have given you in the previous session itself. So what do you think guys, what is the right answer? So those who have not participated, those who have not given the right answer, they can even participate now in the live chat box. So do let me know in the live chat box, what do you think, what can be the right answer here? So I'm waiting for a reply guys, what can be the right answer here? So right answer would be option number B, that is government expenses exceed government revenue. Look, we are talking about the deficit, right? When we are talking about the deficit, which means expenditure is more than revenue part, right? This we have discussed in yesterday's sessions also. So suppose if you are earning rupees 100, if you are earning rupees 100 and you are spending rupees 120 every month, which means you are in a negative balance of rupees 20 every month, right? So this is a deficit. So similarly, when we say that budget deficit is basically there is the government expenditure is more than government revenue, this is the budget deficit. Budget is basically presented every year in the parliament, which consist of basically government receipt and government expenditure. So when expenditure is more than government receipt, so that is basically the budget deficit, right? Now let's begin. But here you can see the slide is still blank. No one has given the right answer, so this slide is blank, and I'm waiting to add some names in this slide particularly, but you guys are not participating, so it should be basically completely filled, right? So you have to participate in the session Also at the end of this session, I will be giving you one achiever question. So if you are basically answering that particular achiever question, so your name would be displayed in the next session also. Now, so get back to the today's agenda. That is question number first of today's session. That is, which of the following best describes the balance of payment? बताइए, which of the following best describes the balance of payments? Options are a record of all financial transactions of a country's government with its citizens, a systematic record of all economic transactions of residents of a country with the rest of the world during a given period of time, a summary of a country's domestic trade activities, a detailed report of a country's internal budget and spending, and a list of all the debts and credits of a country's government. Do let me know, friends, what do you think? What can be the right answer here? You have to participate. Okay, so KS Parmeshwar Kumar is saying option number B. Okay, let's check. So right answer is option number B only. Very good. So well attempted, KS. So right answer is a systematic record of all economic transactions of residents of a country with the rest of the world during a given period of time. So this is the basically balance of payment, which is a systematic record of all the transactions. What we track in the balance of payment, the inflow and outflow of foreign exchange, right? This we only track under the balance of payment. So it is a systematic record of all the economic transactions, whatever imports we are making, whatever exports we are making, right? So basically that is a systematic record of all the transactions from where foreign exchange is inflowing or outflowing. So nachos and cheese is saying option number E. No, it is not option number E. It is option number B. Here under this balance of payment, what we consider, we measure the inflow and outflow of foreign exchange, right? So that is why it is a systematic record of all economic transactions of a residents of a country with the rest of the world during a given period of time. But well attempted. Keep attempting, guys. तभी यहाँ पे you will get to know, because when you not commit mistake, right? So basically you cannot focus on the risk of that, right? So you have to commit the mistake. These sessions are conducted so that you can gain something. You can commit mistake so that in the actual examination you don't commit mistake, right? So do participate in the session. Now, this is the explanation which you can read. Moving on to the question number second. So question number second is, which of the following components is included in the current account of a nation's balance of payment? Read the question carefully. The question is, which of the following component is included in the current account of a nation's balance of payment? Options are foreign direct investment, exchange of goods, that is exports and imports, purchase of foreign assets, government borrowing from foreign sources, or long-term loans to foreign countries. So KS Parmeshwar Kumar is saying option number B, exchange of goods. Okay. Anyone else who want to answer this particular question? Nachos and cheese. Do let me know, what do you think? What can be the right answer of this question? So right answer is option number B. KS, you have given the right answer here. So basically balance of payment has three components, right? Current account, capital account, and the financial account, right? When we talk about the current account, so current account, what we include basically the import and exports of goods, the import and export of services, right? Remittances are also the part of current account. So that is why this is exchange of goods, that is export and import of goods, is a part of current account of nation's balance of payment. So nachos and cheese is also saying option number B. You both are correct. Well done, guys. Well attempted. Now here you can read, the current account of a nation's balance of payment includes the exchange of goods, export and import, the exchange of services, and unilateral transfers such as monetary gifts or transfer payments to and from other nations. These components reflect the flow of payment between one country and other countries resulting from trade and transfer, right? Now, moving on to the question number third. So question number third is, which of the following best describes the balance of trade? Now, this can be tricky, guys, right? Read the question carefully. Which of the following best describes the balance of trade? Options are the difference between the value of a country's total exports and total imports of goods and services in a given period, the total value of all financial transactions between a country and the rest of the world in a given period, the difference between the value of exports and value of imports of goods of a country in a given period of time, the sum of all monetary gifts and transfer payments to and from other nations, and the record of a country's government borrowing from foreign sources. Do let me know, guys, what do you think? What is the correct description of balance of trade? So KS has already given his answer. He is saying that option number A is the right answer. Do let me know. I'm waiting for others one also. Nachos and cheese, what do you think? What can be the right answer here? So guys, right answer of this question. Okay, so nachos and cheese is saying option number C. So option number C is the right answer, KS, here, because when we talk about balance of trade, right? When we talk about balance of trade, so we do not take into account the services. Keep in mind, do not get confused with respect to the balance of payment. So balance of payment and balance of trade is different, right? In the balance of payment, we take into account goods also, services also, capital account transactions also. But when we talk about the balance of trade, so here we specifically take the difference between value of exports and value of imports of goods of a country in a given period of time. And this question was asked 2 years back in the NABARD grade A examination, right? And maximum, most of the students have given the wrong answer because they got confused in balance of trade and balance of payment, right? So I hope now you are getting it. This is the balance of trade and not the balance of payment. So here you can read, the balance of trade specifically refers to the difference between the value of a country's export and import of goods over a certain period. It is a key component of country's current account and indicates whether a country has a trade surplus or trade deficit. Got it? But well attempted, guys. Keep attempting the question. Question number 4 is, when is the balance of trade said to be in balance? Right. Read the question carefully. When is the balance of trade said to be in balance? Options are, when the value of a country's export of goods exceeds its imports of goods, when the value of country's import of goods exceeds its export of goods, when the value of country's export of goods is equal to its import of goods, when the value of a country's export and imports of services are equal, or when the value of a country's total financial transactions with the rest of the world are equal. So KS has given his answer, that is fourth C. Okay. Nachos and cheese, what do you think? What is the right answer, guys? And I request everyone to participate. Do not worry about the wrong attempt, right? Because we do not have any provision of negative marking here. So even if you are attempting question incorrectly, no one is going to penalize you, right? So do not worry about that. This will definitely help you to gain confidence. So nachos and cheese is also saying option number C, right? So correct, option number C is the right answer. Whenever we are saying that balance, right? Balance means whatever you are earning, that much you are spending, right? So your income is equals to your expenditure, then we will say that thing is in a balance, right? So right answer is option number C only, when the value of country's export of goods is equal to import of goods, right? Then we will say that our balance of trade is in balance. And since we are talking about balance of trade only, so goods will only be included here. I hope you got the clarity. So the balance of trade is said to be in balance when the value of a country's export of goods is equal to its import of goods. This means that the country is neither experiencing a trade surplus nor a trade deficit. Okay? Then in that case, we would say that the balance of trade is in balance. Now guys, question number 5. What condition leads to a surplus balance of trade or trade surplus? Read the question carefully. What conditions leads to a surplus balance of trade or trade surplus? Options are, when a country's import of goods exceed its export of goods, when a country's export of goods are equal to its import of goods, when a country's export of goods exceed its import of goods, when a country's total financial transactions with the rest of the world are balanced, and when a country's import of services exceed its export of services. So KS has given his answer, that is C. Okay, now I'm waiting for other answer also. So do let me know, friends. Everyone is not participating, only 2 aspirants are participating, KS and Nachos. So do let me know, guys. I'm waiting for others reply also. What do you think? What can be the right answer here? So Nachos is saying option number C, right? So right answer is option number C only, when a country's export of goods exceed its import of goods. So these all are basic concepts which you need to have a clarity, right? Because these are very, very important. These kind of basic questions are asked and sometimes we are not able to mark them right. So when we are talking about surplus, right? Surplus means if you are earning rupees 100, for example, if you are earning rupees 100 a month and you are spending rupees 80, so which means you are in a positive balance of rupees 20, which means you are in a surplus balance, right? You are in a surplus position. So this is the same case in the case of balance of trade also. When a country's export of goods exceed its import of goods, means our exports are more than our imports, which means we are having net inflow of foreign exchange, right? So we are having a net inflow of foreign exchange. So that is the basically balance of trade surplus. So well done, you both have given the right answer. This is the explanation part. That is, a surplus balance of trade or trade surplus arises when a country exports more goods than it imports. This means that the country is selling more goods to other countries than it is buying from them, resulting in a positive trade balance. Question number 6. What does the term net invisibles refer to in the context of a country's economy? Right? Read the question carefully. We are talking about net invisibles. Options are, the difference between the value of physical goods exported and imported, the total value of all services and income received from abroad, the difference between the value of export and import of physical goods, the difference between the value of export and import of services, income and transfers, the total value of foreign direct investment in a country. So read the question carefully, guys. We are talking about net invisibles. Okay, so KS is saying option number D. Okay, anyone else, guys, who want to attempt? Nachos and cheese, what would you like to say here? Which of the following is correct according to you? So KS is saying option number D here. I'm waiting for your reply. Do let me know, guys. Okay, so right answer would be option number D here. That is the difference between the value of export and import of services, right? So here goods are not included. Under the net invisibles, goods are not included here. Okay, services, income and transfers are included, which we cannot see basically, right? So that is why Nachos and Cheese is saying option number A. No, option number A is not there. We are talking about net invisibles, right? And this is about the physical goods. So physical good is not included. Physical goods is included in the balance of trade. This is the basically balance of invisibles basically, right? So that is why option number D is the right answer here, not B. Option number D would be the right answer, where we consider difference between value of export and imports of services, incomes and transfers. I hope you are getting it. Well attempted, friends. Now, moving on to the explanation part of this question, net invisibles refers to the difference between the value of a country's export and import of invisibles over a given period. Invisibles include services such as IT services, tourism and financial services, income like remittances and investment income, and current transfers such as foreign aid. So all these are the part of invisibles. Right? All these are the parts of invisibles. Right? When we talk about the goods, so that is a part of balance of trade. Net invisibles play a crucial role in a country's balance of payment, as a surplus or deficit invisibles can significantly impact the overall current account balance. A positive net invisibles figure indicate that the country is earning more from these sources than it is spending, while a negative figure suggests the opposite. Right? Now, moving on to the question number 7. What does the term net transfer, right? Do let me know, guys. What does the term net transfer refer to in the context of international economics? Options are the difference between the value of exported and imported goods, the difference between investment income received and paid abroad, the difference between gifts or transfers received from other nations and transfers sent to other nations, the total value of foreign direct investment in a country, or the net income from international trade in services. So KS has given his answer, that is C. Okay, anyone else, guys? So do let me know, guys. Everyone should participate in the session. Do not worry about the wrong attempt. I already told you, we are not going to penalize you, right? Rather, this is going to be a learning for you. So when you commit mistakes in these sessions, so you do not commit mistakes in actual examination, and this is the intention behind these sessions, so that you can gain something, you can commit mistakes and you can learn from these sessions itself. Okay, so you both are saying option number C. Only 2 serious aspirants I can see in the live chat box, KS and the Nachos. So right answer is option number C only. That is the difference between gifts or transfers received from other nations and transfers sent to other nations. I hope now you got the thing. What is included in balance of trade, what is included in net invisibles, and now what is included in net transfer, that is gift or transfer that we are giving, right, and we are receiving. So that is the basic difference between the gifts or transfer that we are receiving from other nations and that we are transferring to other nations. So that is the difference between both of them, is the net transfer. Very well attempted, guys. So explanation is net transfer refer to the difference between the value of transfers or gift received from other nations and the transfers sent to other nations. These transfers can include gifts or remittances between individuals, as well as financial aid or other transfer between governments. Net transfer are an essential component of the current account. This is also part of current account, right? So goods, services, transfers, these all are the part of current account only in a country's balance of payment, influencing whether the current account is in surplus or deficit. A positive net transfer figure means that the country is receiving more in transfer than it is sending, and while a negative figure indicates the opposite. Got it? Moving on to the question number 8. What does the capital account track in a country's balance of payment? Do let me know, guys. Till yet we are talking about the current account components. Now we are moving towards the capital account. So what does the capital account track in a country's balance of payment? Options are the exchange of goods and services between countries, the flow of remittances and foreign aid into a country, all overseas transactions such as cash, stocks, bonds, and government debt, the balance of trade between export and imports, the allocation of government budgets and spending. Okay. So KS is also KS has given his answer, that is option number C, all overseas transactions such as cash, stocks, bonds, and government debt. Okay. So this is according to the KS. Okay. So do let me know, nachos and cheese, what do you think? What is the component of capital account in the country's balance of payment? Nachos is also saying option number C, but guys, option is C is the right answer. That is all overseas asset transactions such as cash, stocks, bonds, and government debt. So very good, well attempted, guys. This is the right answer. This is the right attempt. So option number C would be the right answer. So basically balance of payment के तीन part होते हैं. I told you, current account, capital account, and financial account. So in the basically capital account, what we take a long term transactions. ठीक है, long term transactions we take into account the under the capital account component. So you can read the capital account in a country's balance of payment track all overseas asset transactions, and asset can be in any form of wealth such as cash, stocks, bonds, or government debt. Then further, the capital account records the financial flows associated with these assets, including purchase and sales between residents of a country and foreign entities. For instance, when an investor in one country buys stock or bonds from other country, these transactions are recorded in the capital account. For example, whatever foreign direct investment we are receiving, whatever foreign portfolio investment we are receiving. Similarly, we are also making foreign direct investment in other countries. We are also purchasing the stocks in the foreign stock exchange market, right? So these all are the part of capital account transaction. Also, its components are net external borrowing, net external assistance, and net banking capital. Question number 9 is, what does the surplus in the capital account indicate? Do let me know, what does the surplus in the capital account indicate? Options are capital outflow exceed capital inflow leading to a deficit, capital outflow exceed capital inflow leading to a deficit. I think this option is repeating, right? Capital inflow are greater than capital outflows result in surplus, the government's revenue exceeds its expenditure, or the central bank has increased its interest rate to control inflation. So KS is saying option number C. Okay, capital inflows are greater than capital outflows. Okay, so I'm waiting for another answer. Do let me know, nachos and cheese, what do you think? What is the right answer here? Okay, so both are saying option number C. So option number C is correct. ठीक है, capital inflows are greater than capital outflows resulting in surplus. So whenever we are talking about the surplus in capital account, so basically what is happening here? So whatever foreign exchange we are receiving as a part of capital account transaction, that is more than the foreign exchange that we are basically giving to the foreign countries as a part of capital account transaction. So that is the basically capital account surplus, right? A surplus in the capital account occurs when the inflow of capital into a country are greater than outflow of the capital to other country. This surplus indicates that the country is receiving more capital than it is sending out, which can be used to finance its current account deficit or build up foreign exchange reserves. The capital account is a key component of country's balance of payment, reflecting the net change in the ownership of national assets. So very well done, guys. You guys are attempting very well. Question number 10 is, what does a balance of payment surplus indicate? Now guys, read the question carefully. We are talking about balance of payment surplus indicate, right? So don't get confused. Read the question carefully. Options are, the country has a net outflow of payment with more money going out for imports, transfers, or investment than coming in. The balance of payment is exactly zero, indicating that inflows and outflows are perfectly balanced. The country has a net inflow of payment with more money coming in for export, transfers, or investment than going out. The country is experiencing a trade deficit with imports exceeding exports, or none of the above. So friends, what do you think? What is the right answer here with respect to the balance of payment surplus? Because KS is saying option number C. Okay. So nachos and cheese, what do you think? What can be the right answer here? So right answer would be option number C here, right? The country has a net inflow of payment. So nachos is also saying option number C. Well done, you both are correct. right? So countries has a net flow of payment with more money coming in for export, transfer or investment than going out, right? So here what we are taking into account, we are taking into account the current account transaction, the capital account transaction, and we are clubbing all these transactions. Then we are basically analyzing whether there is a more inflow of foreign exchange or more outflow of foreign exchange, right? So in the case of balance of payment surplus, there is a more inflow of the foreign exchange considering all the components of balance of payment, current account, capital account, financial account, all the transactions we are taking into account, and then we analyze basically. Okay, so KS is saying, sir, whenever what you are saying, whenever none of the option, none of the above answer is given, it is confusing. Yeah, so this is the practice that regulatory bodies adopt. Basically they intentionally give none of the above so that you get confused, right? So don't get confused. If you have a conceptual understanding, right, if you have a conceptual clarity, then definitely mark your answer. Do not focus on the none of the above, because that is a trick to make your answer incorrect, right? This is a trick that is adopted by the examination taking body. So do not fall into the trap. If you have the clear understanding of the concept, focus on the options, and if you basically believe, if you are convinced that this is the right answer, mark that answer. Do not focus on the none of the above, because none of the above will not always be correct, right? Sometimes it will be correct, but most of the cases it will not be correct. So here is the explanation which you can read, guys. Now, moving on to the question number 11th. What does the term exchange rate refers to? बताइए, what does the term exchange rate? So options are the interest rate charged by banks for loan in a foreign currency, the value of one nation's currency compared to the currency of another nation or economic zone, the amount of foreign currency a government holds in its reserves, the difference between the export and import values of a country, the tax rate imposed on foreign goods and services. So KS is saying option number B. Okay. Nachos and cheese. Okay, you are also saying option number B, right? Okay, so well done. Option number B is the right answer here, guys. That is the value of one nation's currency compared to the currency of another nation or economic zone. So for example, if we are saying that $1 is equals to rupees 80, right? So this is the exchange rate. So what does it depicts basically? It depicts that in order to have 1 unit of the dollar, we need to spend rupees 80. This is the simple explanation of the exchange rate. That is the value of one nation's currency compared to the currency of another nation. So here we are comparing rupees and dollar. So what we analyzing here, that in order to have 1 unit of the dollar, we need to spend 80 rupees, right? So this is the exchange rate. So an exchange rate is the value at which one nation's currency can be exchanged for another nation's currency or a currency used in an economic zone such as the euro in the eurozone. For example, the exchange rate between the Indian rupee and the US dollar would indicate how many rupees are required to purchase $1. Exchange rate fluctuate based on various factors including interest rates, inflation and economic stability, and they play a crucial role in international trade and finance. The exchange rate determines the relative value of currencies and influences the cost of importing and exporting goods between countries. So you guys have given the right answer. Now moving on to the question number 12. So read the question carefully. These all are the application based question. Why might a rise in the price of foreign exchange lead to a decrease in the demand for foreign exchange? Read the question carefully, guys. Why might a rise in the price of foreign exchange lead to a decrease in the demand for foreign exchange? Options are: it makes domestic goods cheaper for foreigners, it increases the availability of foreign goods in the domestic market, then further it raises the cost of purchasing foreign goods, reducing demand for imports, it increases the purchasing power of the demand domestic currency in the foreign market, or it decreases the value of a foreign financial assets. Now this can be tricky, guys. Do let me know what do you think, what can be the right answer of question number 12. Okay, so I'm waiting for your reply, guys. Do let me know. KS is saying option number E. Okay, anyone else? Nachos, what do you think? What is the right answer? I know basically you guys are getting confused here. So Nachos is saying option number C, or KS is saying option number E, right? So option number C is the right answer. Well attempted, Nachos, and I think KS got confused. So the explanation is it raises the cost of purchasing foreign goods, reducing demand for imports, right? So what is happening here? Look, you can read this basically. So when the price of price of foreign exchange rises, it means that then more domestic currency is needed. For example, basically if I am saying that $1 is equal to rupees 80, right? This is the normal exchange rate. But when the price of foreign exchange rises, which means now $1 is equals to rupees 90. This is the case, right? Which means what is increasing here? The exchange rate is increasing here. So you can read here. It means that more domestic currency is needed to purchase a given amount of foreign currency. This makes foreign goods and services more expensive for domestic consumers, because if they import, right, if they import any foreign goods or services, earlier they used to pay basically for $1 80 rupees, but now if they are importing the same goods, they have to pay rupees 90, which leads to reduction in the demand for imports, and as a result the demand for foreign exchange also decreases, because why did we need the foreign exchange? In order to payment the imports, right? But since we are not importing, so in that case the foreign exchange demand will also decrease, because fewer people and business are seeking to exchange their domestic currency for foreign currency. This relationship between the price of foreign exchange and the demand for it is a key principle in understanding how exchange rate affect international trade and capital flows. I hope you got the point, right? Now, moving on to the question number 13th. So, question number 13th is, how does a rise in the price of a foreign exchange affect India's export and the supply of foreign exchange? Again, read the question carefully, guys. Here, I have added some application-based questions which are very tricky and very crucial for the understanding part. So, how does a rise in the price of foreign exchange affect India's exports and the supply of foreign exchange? Options are: it increases the cost of Indian products for foreigners, reducing exports and foreign exchange supply. It decreases the cost of Indian products for foreigners, increasing exports and foreign exchange supply. It has no effect on the cost of Indian products for foreigners or the supply of foreign exchange. It decreases both India's exports and the demand for foreign exchange. It increases the demand for Indian currency, leading to decrease in foreign exchange supply. Do let me know. So KS has given his answer. He's saying option number B. Okay, so now Nachos is saying option number B, right? So both are saying option number B. So B is the right answer here. It decreases the cost of Indian products for foreigners, increasing export and foreign exchange supply, right? So what is happening here? Here we are seeing there is a rise in the price of foreign exchange. For example, earlier it was $1 is equals to rupees 80, but now it is $1 is equals to rupees 90, right? So what is happening here? Earlier the Indian producers, those who were exporting the things, so for every dollar they were getting rupees 80, but now for the same set of goods and services they are getting rupees 90, right? So what will happen here? Here export will increase, because for the same set of goods earlier they were getting 10 rupees lesser, now they are getting 10 rupees more, so in that case they will push for more export, right? So similarly there will be an increase in exports and foreign exchange supply. Got it? You both have given the right answer. So here you can read the explanation also. When the price of a foreign exchange rises, it means that foreign currencies like USD have become more valuable relative to the Indian rupee. For foreigners, this effectively lowers the cost of purchasing Indian goods and services, making them more attractive. As a result, India's exports are likely to increase, because foreign buyers can get more for their money. Because earlier they were getting goods worth of rupees 80, right? But now since the exchange rate is increasing, basic to now basically what they are getting goods worth rupees 90, right? So that is why they will demand more, and also Indian producer will export more. So this increase in export leads to higher inflow of foreign exchange into India, thereby increasing the supply of foreign exchange. The dynamic highlights the relationship between exchange rate, international trade, and the flow of foreign currency into a country. Moving on to the question number 14th, which of the following is a reason why foreign currency flows into a home country? Again, read the question carefully. Which of the following is a reason why foreign currency flows into a home country? Options are: domestic consumers purchasing foreign goods, foreigners buying the home country's assets, the home country reducing its imports, the home country increasing its tax rates, or the domestic companies investing in foreign countries. So KS is saying option number C, that is the home country reducing its imports. Okay. Anyone else? Nachos, what do you think? What is the right answer here? So you, okay, Nachos and Cheese is saying option number B, and KS is saying option number C, right? So right answer is option number B only, that is foreigners buying the home country's assets. Okay. So why basically here, why basically foreign currency will flow into home country? Because now suppose Mr. Michael is residing in the USA, he is a USA citizen, and he wants to purchase assets. He want to invest in India's stock market. So what he will do basically, he will bring dollar into India, right? And then he will basically purchase the foreign the basically Indian stocks, right? So that this is how basically foreign currency flow into a home country is increasing. Got it? So this is the right answer. So this is what I'm saying. Basically, you have to read the question carefully and understand the concept. So foreign currency flows into a home country for several reasons. There are multiple reasons. For example, one major reason is when foreigners purchase assets in the home country, such as real estate, stocks, or bonds. Additionally, foreign currency enters the home country when its goods and services are exported and bought by foreigners. Other sources include remittances or gifts sent by foreigners to individuals in the home country. These inflows contribute to the foreign exchange reserves of the home country and are crucial for maintaining a balanced current account. The inflow of foreign currency is important for a country's economy as it helps in stabilizing the exchange rate and can be used for various purposes, including paying for imports and servicing foreign debt. So Nachos has given the right answer this time. Now, moving on to the question number 15. Again, guys, try to understand what is a fixed exchange rate. This is the question. Try to apply the logic. What is the fixed exchange rate? Options are an exchange rate that fluctuates based on supply and demand in the foreign exchange market, an exchange rate that is determined by international agreements between between countries, an exchange rate that is established at a specific level and maintained through government actions, typically by a central bank, then an exchange rate that changes daily according to the inflation rate of the home country, an exchange rate that is determined by the economic performance of a country. So what is the right explanation of this question, fixed exchange rate? So KS is saying option number C. Okay, I am waiting for another reply. Nachos is saying option number A. Okay, so now this time KS is correct. That is an exchange rate that is established at a specific level and maintained through government actions, typically by a central bank. So what is happening in the fixed exchange rate? That exchange rate is fixed basically. For example, if government is saying $1 is equal to rupees 80, so this will remain same irrespective of the demand and supply of the foreign exchange, right? So this is the fixed exchange rate. So this will be changed when government or central bank interfere and they will further change it. Otherwise, it is fixed till unless and until it is changed next time, right? So that is why option number C would be the right answer. I hope you got it. So an exchange rate that is established at a specific level and maintained through government actions, typically by a central bank. So fixed exchange rate is a type of exchange rate regime in which a country's currency value is tied or pegged to another major currency like the US dollar or basket of currencies at a predetermined rate. This rate is maintained by the country's central bank through various actions such as buying or selling foreign currency, reserve or adjusting interest rates. The purpose of a fixed exchange rate is to provide stability in international prices, reduce uncertainty in trade and investment, and control inflation. However, maintaining a fixed exchange rate can be challenging, especially in the face of economic pressures or speculative attacks on the currency. It requires the central bank to actively intervene in the foreign exchange market to keep the exchange rate at the desired level. Question number 16, guys. Again, very, very important. What does the term devaluation refer to? Options are increasing the value of a nation's currency relative to other currencies, allowing the currency value to float freely without government intervention, reducing the price of a nation's currency in terms of other currencies, fixing the exchange rate of a currency at a higher value, or strengthening a nation's currency by accumulating foreign reserves. Try to understand the things. Okay, so KS is very quick. He's saying option number A. Read the question carefully, KS. I would repeat again, read the question carefully. We are talking about devaluation. So don't be in a hurry, guys. Read the question carefully, read the options carefully, then try to attempt the question. Okay. So, okay. So KS is saying option number A, Nachos is saying option number C. So right answer is option number C only. Why? Because we are talking about devaluation, right? We are not talking about revaluation. We are talking about devaluation. So what is happening in the devaluation? There is a reduction in the price of a nation's currency in terms of other currency. So basically the value of currency, the value of domestic currency is basically decreasing, is being decreased by the government in terms of the other currencies. So यहाँ पे intentional deliberate effort is being taken by the government and the central bank, and they are basically decreasing the value of our currency in comparison to other currencies, right? So this is the right answer. This is the devaluation, right? That is the option number C would be correct here. So devaluation refers to the deliberate reduction in the value of a nation's currency relative to other currencies, usually carried out by the government or central bank. This reduction in the exchange rate means that the currency is now worth less in terms of foreign currencies. Devaluation is often used as a tool to make the country's export cheaper and more competitive in the global market, while making imports more expensive. This can help stimulate domestic production and reduce trade deficits. right? Now, moving on to the question number 17th. What is the primary purpose of a government devaluing its currency? Again, very, very important, guys. So try to understand the concept, then apply your logic. Options are to increase the value of foreign imports and decrease the value of domestic exports, to lower the price of the country's exports and raise the price of foreign imports, boosting domestic production, to reduce inflation by making foreign goods cheaper, to attract foreign investment by making domestic assets more valuable, to stabilize the currency by fixing it to the value of another currency. So, what is the primary purpose of government devaluing its currency? What is the right answer, guys? I'm waiting for the reply. Okay, so KS is saying option number D, Nachos is saying option number B. Right answer is option number B, to lower the price of the country's exports and raise the price of foreign imports, boosting domestic production. So what is happening here? Look, what is happening in the devaluation? Basically, when government is devaluing its currency, which means government is decreasing the value of our currency. So earlier, $1 is equals to rupees 80, right? Earlier, $1 was rupees 80. Then what is government doing? Basically, government is decreasing the value of our currency, which means now government is making rupees 90, ठीक है, making it to rupees 90, which means now in order to have 1 unit of the dollar, we need to spend rupees 90. So what is happening here? The value of our currency is decreasing here, right? This is not the revaluation, this is rather a devaluation, because earlier we needed to spend rupees 80 in order to have 1 unit of dollar, but now since our currency is being devalued, so we need to spend rupees 90 in order to have 1 unit of dollar. Now look from this perspective. So earlier what was happening? Basically, when our producers were exporting, so they were getting the payment in terms of basically dollar, right? So for every dollar they were getting rupees 80. So when they used to go to the bank, so bank was basically converting the dollar into rupees, right? So for every dollar, bank was giving them rupees 80. But now since the value of our currency is decreasing, so for the same set of goods, the Indian producers are getting rupees 90, right? So this is the basic purpose behind the devaluation of the currency, to increase the exports of the currency of our country, right? And this is how exports will be increased basically by devaluing our currency, so that our producer will get more amount in with respect to the dollars. I hope you are getting it. So this is the explanation, guys, which you can read. I hope you got the concept. Question number 18th is, what does the term revaluation refer to? Now, I hope you got the idea of devaluation. Now, do let me know, what do you think? What is the revaluation here? So options are: reducing the value of a nation's currency relative to other currencies, allowing the currency value to be determined by market forces without government intervention, increasing the price, that is increasing the exchange rate of a nation's currency in terms of other currencies, fixing the exchange rate of a currency at a lower value, or weakening a nation's currency by selling foreign reserves. What do you think? What is the right answer of question number 18th? So Nachos is saying option number C. Okay. KS, what's your call with respect to question number 18th? Do let me know. I'm waiting. What do you think? What is the right answer of question number 18th here? Okay, so you are also saying option number C. Option number C is the right answer. That is increasing the exchange rate of a nation's currency in terms of other currency. So what is the meaning of revaluation? Basically, revaluation is basically, so same example, right? Earlier, $1 is equals to rupees 80 was the exchange rate. Now, since government is doing revaluation, basically now government is increasing the value of our domestic currency, which means now $1 would be is equals to rupees 70. Right, so this would be the case here. So this is the revaluation. Revaluation is the basically deliberate effort of the government and the central bank to increase the value of domestic currency in terms of other currencies, right? So that is why option number C would be the right answer here. You can read the explanation. Revaluation refers to the deliberate act of increasing the value of nation's currency. So we are increasing the value of our domestic currency relative to the other currencies typically carried out by the government or central bank. This increase in the exchange rate means that the currency is now worth more in terms of foreign currencies, and revaluation is often used to curb inflation by making imports cheaper, which can reduce the cost of goods and services within the country. Question number 19, guys. What is the purpose of revaluation in terms of foreign exchange, and how is it typically implemented? Do let me know what is the basic purpose of revaluation. to increase the price of foreign imports and decrease the price of domestic exports implemented by selling the nation's currency and buying foreign currencies, to raise the price of the country's exports and lower the price of foreign imports implemented by buying the nation's currency and selling foreign currencies, to stabilize the exchange rate by adjusting domestic interest rates implemented by changing government policy, to balance the trade deficit by encouraging more foreign investment implemented by increasing foreign exchange reserves, to reduce inflation by decreasing the cost of domestic goods implemented by controlling money supply. So Nachos is saying option number B. What do you think? KS, what do you think? What is the right answer? What is the purpose of revaluation? I'm waiting for the reply. So right answer would be option number B here. That is to raise the price of the country's export and lower the price of foreign imports implemented by buying the nation's currency and selling the foreign currencies, right? So what is happening here? KS is saying option number E. No, option number B is the right answer here. Basically what is happening here? In the revaluation, I told you the example, basically $1 was rupees 80, right? This is for example. Now, if we are doing revaluation, which means we are increasing the value of domestic currency, now $1 would be rupees 70. So what will happen basically? What will happen here? When we are earlier when our producers were making the imports. So in that case, basically they needed to pay rupees 80 for every dollar. But now, since our currency is being appreciated or our currency is being revalued, so what is happening for every dollar of import? They have to pay only rupees 70. So this is the basically win-win situation for the importers, because now import will increase, and this is basically done for countering the effect of inflation in the economy, right? So if there is a high inflation in the economy, so in order to get the cheaper imports, basically revaluation is done by the government or the central bank. So this is the explanation which you can read. Now question number 20th, what does a flexible exchange rate system involve? Do let me know guys. Options are active government intervention to stabilize currency value through buying or selling foreign exchange, a fixed exchange rate where the currency value is pegged to another currency or basket of currencies, a hands-off policy where the exchange rate is determined solely by market forces without government intervention, a system where the central bank sets a specific target for the currencies and adjusts monetary policy to maintain it, and value an exchange rate policy that involves setting an upper and lower bound for currency value and intervening when limits are breached. So Nachos is saying option number A. Okay. And KS is saying option number C. Okay. So right answer is option number C here. We are talking about the flexible exchange rate, not the fixed exchange rate, right? So option number A is basically active government intervention to stabilize currency value through buying or selling. This is a fixed exchange rate that we have already discussed. Now we are talking about the option number C, that is hands-off approach, where the policy exchange rate is determined solely by the market forces without government intervention. So basically under the flexible exchange rate system, what is happening? The exchange rate is decided based on the market forces, that is demand and supply of the currency itself, right? Under the fixed exchange rate, it is a basically deliberate action on the part of government and the central bank, but there is no intervention, there is no interference in the case of flexible exchange rate, and exchange rate is completely determined based on the market forces, demand and supply of the currency, and that is why option number C would be the right answer here. Got it? So this is the explanation that you can read. Now guys, this is the achievers question. Those who are new to the session, I would like to tell them that this is the achiever question. So those who give the right answer of this question in the comment box, not the live chat box, we display their name in the next session, right? So we would not discuss the answer in this session. We would discuss the answer of this question in the next session. So question is, in a flexible exchange rate system, what is the likely effect on an external value of a currency if there is a balance of payment deficit? Options are the external value of the currency would tend to fall. The external value of the currency would tend to rise. The injections from trade are greater than the withdrawals. Aggregate demand is increasing, and none of the above. So the answer of this question you are not supposed to give in the live chat box. You have to give the answer in the comment box, and those who would be giving the right answer, their name would be displayed in the next session, because in the next session we first discuss the achiever question of the previous session, then we take the agenda of the day. So this is the achievers question which you have to answer in the comment box. And guys, this is all with respect to today's session. And if you are an aspirant of RBI Grade B 2025 examination, if you are planning to start the preparation for RBI Grade B 2025 examination, so friends, we have started this foundation course, which is Lakshya batch, right? This is the Lakshya batch, guys. And as a part of this Lakshya batch, what we are providing, basically, we are providing extensive live classes for all the components, of RBI Grade B examination, be it phase 1, be it phase 2, quant, reasoning, English, current affairs, finance management, ESI, descriptive English. For all the components, we are providing you the extensive live classes here. And the basic purpose of the live classes is to cover the things from very scratch. Considering that you are completely new to the subject, you might have not read the economics, you might have not read finance part during your college curriculum. So friends, we are having this mindset that you may be a complete fresher, you may not have the idea with respect to this component. So in the live classes, we are starting the things from very scratch, covering all the possible dimensions as a part of this, because we are having sufficient time, so we would be covering the topics in depth. And also in this, as a part of this course, we are not focusing on only syllabus completion. Syllabus completion is an important part, but along with that, we are focusing on foundation building, right? Foundation building and also the knowledge enrichment, because when you enter into RBI as a RBI Grade B officer, there the most required subject is the economics and finance. So if you have the basic understanding with respect to the concepts of economics and finance, so that would be very helpful for you as a RBI Grade B officer. And keeping this in mind, we have launched this batch, guys. So live classes is one of the most prominent important feature, and along with that, we are providing one-on-one mentorship. So whenever you feel that you need any guidance, you want to connect with any faculty, what you can simply book the slot with that faculty, and you can ask whatever you want to ask with respect to your query, with respect to the exam preparation, with respect to the content doubt, right? Whatever you want to ask, you can ask in the session. So along with that, we are also providing descriptive writing component and the interview guidance program. So all are the prime features, guys, and the link of this course is given basically in the description. You can click on the link and you can check all the details here. And guys, here also we are offering you the discount, so you can use the coupon code Prakash while subscribing the course. This is my name, and that will also work as a coupon code, right? So when you apply this coupon code, you can see a drastic discount on the final prices, so that will make the course more affordable for you. And I always say, guys, if you are a serious aspirant, do start the preparation as soon as possible. Do not wait for the December and January, because at that point of time, you would not be able to complete the syllabus, you would not be able to complete the current affairs, you would be facing the challenges regarding the revision part, descriptive writing part. So if you are a serious aspirant, if you want to prepare, this is the perfect time to start the preparation, and this can be one of the best course, guys. So analyze all the courses. I'm not saying take decision immediately, analyze all the courses, take informed decision, but I can assure you, guys, this can be one of the best platform, because here we are focusing on extensive live classes from scratch. Things will be covered in a layman language with a realistic example, so that you can understand the concept. Your foundation should be stronger, right? This is our basic objective, and we are trying to keep cost as minimal as we can. So that is why we are already providing you course under discounted prices, guys, and further we are providing you the coupon code, so that you can apply the coupon code and you can have further discount, right? So again, I would say the link is given in the description, guys. Check all the possible details and take the informed decision. But if you're a serious aspirant, guys, start the preparation as soon as possible, and do join this Telegram group. This is my personal Telegram group. Do join this Telegram group, because once you join this Telegram group, so what will happen, whatever query you have, minor, major, you can simply ask in this group itself, and I'll personally be taking care of your query, because this is my personal query, a personal group basically. And also on a regular basis, I would be sharing some updates regarding to the important sessions, important examination updates, so that I would be sharing on a regular basis in this Telegram group only, right? So thank you very much for attending the class, and I hope you enjoyed the discussion. We'll meet in another